Ladies and gentlemen, welcome to our latest edition of our Basel 4 channel. Today, again, we have a special edition where we present to you a topic that is not directly related to Basel 4, but of course, indirectly. Today's special edition will be again around IFRS 9 and the challenges and the requirements of IFRS 9, specifically about the challenges regarding the validation of IFRS 9 models. As you know already from our previous editions, special editions of our Basel 4 channel regarding IFRS 9, you know that one of the biggest changes from IAS 39 to IFRS 9 is the calculation of risk provisions. This means that institutions will have to calculate their credit risk provisions based on expected loss over the lifetime. In prior Basel 4 channel episodes, we presented already the requirements and the challenges regarding the development of these models for the estimation of expected loss over the lifetime. And today we will focus on what follows after the implementation, which is the validation of these models and also of the audit of these models by supervisors, external or even internal auditors. But first things first, let me first introduce myself quickly. My name is Martin Neisen. I'm a partner at PwC in Frankfurt. Apart from that, I'm also leading the Global Basel 4 initiative. And as always, I am not alone. Today I have three more colleagues from our regulatory quant team who are currently heavily involved in projects about IFRS 9 implementation and also validation, but also, of course, are engaged in projects around Basel 4, especially when it comes to IRB implementation and TRIM. Guys, would you like to introduce yourself? Kaan, you start, please, and then, of course, you can directly take over the presentation. Thanks.
Thank you, Martin. Kaan, Aksel, I've been working closely with Martin on various initiatives related to IFRS 9 and target review of internal models within the context of Basel 4 initiative. And we have here, we are going to discuss about significant issues related to IFRS 9 frameworks that has been currently developed and impairment frameworks currently initiated by various banks. I have here two colleagues who will be joining me in a discussion today, Iosif and Petr, and they can introduce themselves.
Hello everyone, my name is Iosif. I'm a manager in regulatory management, Frankfurt, Germany. And for the past several years, I've been working on topics related to IFRS 9 implementation, since it's very important right now for banks, and as well the future of IRB, for example, specifically the preparation for ECB on-site inspections and the implementation of new EBA requirements towards the IRB approach.
Hello colleagues, my name is Petr Geraskin. I am senior consultant regulatory management team. For several years I have been working on IRB project and IFRS 9 related projects in different countries, including Russia, Germany, Belgium, Turkey and Greece. And today I will talk about IFRS 9 review and audit tool which we are currently developing in regulatory management team.
Yeah, thank you, Petr. When we look to agenda for today, we would like to briefly introduce the general idea of validation of IFRS 9 models. What are the major components of such models, including the validation of the PD and LGD risk parameters, which are used in the estimation of ECL. Finally, ECL numbers for the outstanding exposures, and then we will look as well into the concept of staging, how this can be reviewed and validated. And in the final chapters, we'll discuss the tool that has been designed by our teams, which we hope to deploy in various engagements related to audit and review of such frameworks. On slide number 4, we would like to give you a brief overview. What are the areas, the the review of models quality are going to play an important role in order just to achieve the compliance with the standards. Clearly, we need to have in mind in the first place that every institution should have a regular cycle of validation that includes monitoring of the model's performance, model stability, generally stability of the ECL estimation process, the review of the model relationship, and testing of various outputs against the outcomes, which we sometimes as well call the so-called back testing. When we look into an average IFRS 9 impairment framework, we will realize very fast that there is a methodological design process, and but in this process there are multiple assumptions are made based on the availability of data, desire or wish to establish complex forecasting procedures, and then we have a process which feeds into the models, the relevant input data, which ultimately will be transformed and used in the generation of the outputs, which in return we are using, generally speaking, in the estimation of ECL. Here, relevant inputs are the data, and the quality of data needs to be as well verified, and it has to be in the system of the bank at all times available for basically monthly, quarterly, and annually calculations of ECL. The whole modeling concept depends, as we all know, on a lot of assumptions and ideas that might be not necessarily meeting at all times expectations, and there's a requirement related to monitoring of all these models because they might be not really capturing all the components of the assumptions, might be falling apart. So we need to be alert at all times to see whether this is the case, that the models are not capturing all the risk-relevant information and discrepancies. Similarly, the models, the algorithms, the whole process is usually embedded into the IT framework and the platform of the bank, and we need to make sure that as well the system is functioning properly, adhering to the highest possible standards. And this can only work well if and when we have achieved a higher level of model governance, where we knew for sure under which circumstances the inconsistencies will be escalated and can be remedied across time, even when they are happening. Model governance, as well as all the relevant checks and quality reviews, are in fact mentioned already in various papers, most notably in the BCBS 350 and the IFRS 9 relevant EBA guideline, opinion letters by EBA, where we have clear indication that we need to put in place a strong governance framework to make the whole thing work across time in line with the expectations of the standard. Slide number 5, where we see actually a full-fledged process of model development and validation, initial validation, the approval, the implementation, embedding into the IT platform, and the use in the business context of the models, and the final step being the reporting and the validation, ongoing validation. Means like we have 3 different actually validations that we know from the model development and use. First one is the initial validation, the second one is the ongoing validation, and we have as well the regular validation, which we sometimes as well call the model monitoring. Let's discuss this in further detail, as we see on slide number 6. These are different type of validations, but they all actually geared towards the same objective. We are actually expected to check the performance different points of IFRS 9 impairment assessment life cycle. The initial validation is usually performed before the model has been rolled out, when significant changes are made to the models that the previous validation is not anymore relevant. This includes both the quantitative and qualitative tests, includes the review of the model development procedures and data. The ongoing validation, according to, again, general understanding we have from BCBS 350, should be performed at least once every year, whenever there is a sharp decline of the model performance based on the identified monitoring criteria. And finally, we have the regular monitoring, and this is performed with a higher frequency depending on the data availability. For instance, for retail portfolios, it's not unusual that the monitoring exercises are conducted more than once every quarter, and even at most leading retail banks as frequent as monthly. It consists of qualitative and quantitative tests, and goal is to identify the early signals of a performance decline and deterioration. The components of IFRS 9 validation can be generally described as the quantitative validation and the qualitative validation. The quantitative validation is comprised of all procedures in which we identify the statistical indicators for the ECL components and calculate that and come up with an interpretation on the basis of an empirical data set. There's a degree of freedom in the interpretation of results as usual, but at the end of the day we have clear-cut thresholds under which we can easily identify a model performance decline. The qualitative validation fulfills the primary task of making sure of the applicability and properness of the quantitative methods that has been used in practice. Without a careful review of all these aspects, where a lot of assumptions are made, the IFRS 9 cannot fulfill all the framework of IFRS 9 cannot fulfill all the purposes to achieve the expected higher level of estimation standards. Therefore, all this needs to be assessed at least once every year from a qualitative perspective, taking into account the assumptions. A PD model, as we see on slide number 8, for the purposes of using in the context of ECL estimation, obviously has to fulfill several requirements. And the most notably, it should be reflecting a forward-looking perspective for the next periods in time. It should have as well the conceptual, let's say, extension that the model should be looking forward to many years ahead. We are not here just looking to 1-year horizon, as we have to account for the lifetime PD. If the relevant exposures are staged on stage 2 or 3, we have to be using the lifetime PD. That, in a nutshell, requires that we basically extrapolate from the 12-month PD outlook to a multi-year PD outlook. However, there are a lot of different approaches here which might rely on different assumptions and statistical methodologies. The most commonly seen or commonly applied approach has been, so far as we have observed, the use of transition matrices, which is based on historical observation of the relevant rating information, which again in return could be used to make an estimate for the a longer term PD estimation, more than 12 months. And here as well, we have not to forget the simple fact that we are dealing with IFRS 9 and not with IRB. That means like it has to be a point-in-time estimate where the forward-looking components of macroeconomic effects have to be incorporated into the estimation. This is usually done if you apply the transition metrics approach by linking the through-the-cycle PD with the point-in-time PD using some macroeconomic scaling function. This could be either, as we all know, the application of the Merton approach, where we take a macroeconomic factor as the anchoring point and around which we link the through-the-cycle PD to the point-in-time PD. Clearly, the PD models are different for retail and corporate, and therefore they have to be treated differently depending on the portfolio and segment. But the more important aspect is, as we all know, if the bank or the institution has been using the IRB models, then all the so-called adjustments has been conducted for the sake of conservatism. They need to be removed from the estimation methodology, because that's basically not a requirement of IFRS 9, and we have to make sure that the models are reflecting the best estimate as for the estimation procedure. In the validation of the PD model, there are several areas where we have to pay attention. The most notable ones are we have to look to the data available, sample quality we have to check, confirm that the data used for the modeling is sufficient and can enable us to obtain a reasonable through-the-cycle and point-in-time PD estimates, obviously depending on the model structure. We need to compare as well the development sample to the total available portfolio data and make sure that the representativeness has been achieved on using different sampling techniques. We need to check as well, using some quantitative measures and metrics, the stability and the representativeness of the data used for modeling, and make sure that the representativeness of data for model development and current portfolio are at all times achieved. The classification of risk is as well another topic of importance. Here we have to review the list of risk drivers used for segmentation and make sure that the segmentation in line with our general understanding about the distribution of the exposures. We have to review the PD methodology to confirm approach and make sure that the approach is unbiased by all means. For the model quality, the documentation have to include various calibration. The documentation will include various model ranking tests and calibration tests. Again, we have to assess the performance of extrapolation from 1-year PD to the lifetime PD. Here, depending on the approach chosen by the institution, we may rely on simple tests. If it's a regression approach is used, the level of R-square or Gini. If a transition metrics approach is chosen, the fitting into the transition matrix probabilities have to be verified by all means. If and when the model is used over values of which factors which were not included in the model development, meaning like we are acting more like in an optimistic or pessimistic fashion, we need again make the adjustments to remove this. The forward-looking information is usually incorporated in the last stage to identify a period over which the economic model will give us a general idea about the expectations given the historical data. This will help us to assess how the adjustments are made within the PD model as well. Here we need to assess the performance of forward-looking macroeconomic factors, and we need to check their statistical significance and make sure that they're stable across time. The estimation is not showing volatile jumps based on the rolling data window. Documentation is, as usual, very important, which will be reviewed by a third party, such an auditor or regulator. Therefore, clearly, the review of such development documentation should be an important final step in the conclusion of the implementation projects, and it, as well, the validation context plays an important role because it just reflects the quality of the whole impairment system. The worse the documentation is, the worse the results will be also reflected by regulators and auditors. Well, we wanted as well just to present some tests and analytical procedures, how we might want to verify the validity of the, for instance, migration probabilities or transition matrix probabilities. And for that, commonly used method is the application of the so-called population stability index, which is a non-parametric, non-linear comparative analysis for the sake of finding out the distributions, differences between distributions. If we have two different distributions and we'd like to see how far away they are diverging, then this is one of the best methods that we can even think about. Here, the result should be for all the nodes, or for if we apply it on rating grades across the whole rating grades more than 25% or 0.25, then we can easily identify here a significant divergence in terms of population differences. If it's between 10 to 25%, then the divergence is significant, but still to some extent even maybe acceptable. If it's less than 10%, then obviously we don't need to be concerned with any significant divergence between the two populations. On the right-hand side of that slide number 11, you can also see an example here. Assumably, we have applied a very simplified transition matrix, comprising of just 3 rating grades. Here on the left-hand side, we have the actual results. On the right-hand side, the forecasted, the modeled results, and that has been both denoted as the actual metrics and the modeled metrics. The PCI for each and every rating grade can be calculated based on the differences between the two matrix probabilities, and if and when these are finally on every rating grade calculated, that can be summarized, aggregated together to find out whether it's significant or not. As it can be seen on individual level, the results are in this case not significant. Where we are talking about the first rating grade 1, there the threshold has not been breached. It's about 4.6%, far below the 10%. But when it comes to the rating grade 2, we have there 27%, above 27% value for the PCI index, and then is above 25. So basically, there is a certain divergence what we can observe. The next test of importance could be as well for us the binomial distribution assumption here. Different than the PCI, we just look to this we use usually for the lifetime PD verification and validation. Assume you have an estimate and assume you have a really observed probability for a lifetime PD period, and then you can compare these two based on your observed and realized values. You can create a confidence boundary around your estimation. If the realized values are within these boundaries, obviously you would be feeling comfortable with your results. The binomial test or binomial distribution makes a very interesting assumption that the rating grades are independent from each other in terms of the default correlation. But in fact, as we know, the rating grades are not uncorrelated. However, this is an analytical assumption that they are just assumed to be independent for the sake of this test. Here on the right-hand side, in the example, you see the actual number of probability of defaults and the model defaults, and you want to see whether the model defaults and the actual ones in line statistical terms using the binomial testing approach. And using the binomial approach, we create around the actual defaults a boundary for the first rating grade. For instance, on the lower part of that slide, you'll easily see that we have 2 defaults up to 9 defaults, so 5 is just in between these two. Similarly, for rating grade 2, we have actually observed 12 defaults, and in terms of estimation boundaries, it should be between 12 and 24, so it's still acceptable. It's just on the boundary, on the lower boundary. And for rating grade number 3, we have observed 40 defaults. However, the boundaries were between 42 and 58, so it's below the lower boundary of this test. So it is falling out of the boundaries, meaning like it is a significant divergence from the expectation. Tests like that is commonly used, as I mentioned earlier, for the estimation of the lifetime, for the verification of the lifetime PD numbers. And here I would like to give the word to my colleague Iosif.
Now we'll move over to LGD validation. On slide 13, we have a typical structure of LGD models for IFRS 9 purposes that we see at many banks. So here, as you can see, there are 3 main components: the base LGD model, a multi-year adjustment component, and a forward-looking module. And the reason we see such a structure is that in many banks already in place some LGD models that are used either for IRB purposes or for internal risk management purposes. But to make them compliant for IFRS 9 purposes, a multi-year adjustment has to be made and a forward-looking module has to be added. So, for instance, in IFRS 9 for stage 2, we have to compute lifetime expected credit losses. And these credit losses depend on the point at which the instrument defaults. But internal base models compute only LGDs for the first year. So a multi-year adjustment component has to be put in place in order to calculate what the LGD would be if the loan defaults in the second year of its life, in the third year of its life, and all the way until its maturity. And the forward-looking module has to be put in place in order to incorporate macroeconomic adjustments. IFRS 9 requires us to use macroeconomic factors in LGDs and to incorporate current conditions when we compute LGDs, whereas typical base LGD models used, for instance, for IRB purposes are more based on through the cycle or downturn assumptions. So what this means basically is that when we validate LGDs, we have to validate not only the base LGD model itself, but all these add-on components. Moving on to slide 14, we will look into the different aspects of LGD validation. So the first one is unbiasedness. So for IRB purposes, what banks have to do is to consider through the cycle LGDs, but also add on downturn add-ons on top, and as well consider any margin of conservatism in case there are any deficiencies in the way the model was constructed. But from an IFRS 9 perspective, the LGD methodology should not be conservative or too optimistic. So any conservatism that was added to the models for other purposes would have to be stripped out of the model. This can be checked through a qualitative procedure, but as well quantitative tests exist. For instance, the loss shortfall analysis is a test where a comparison is made between actual losses which were observed for past defaults and LGD model outputs. And when we compare these for IFRS 9 purposes, we would expect that they are quite similar. Next, there are a number of data adjustments and sample manipulations that banks could perform when they're developing LGD models for IFRS 9 purposes. And the reason is because IFRS 9 requires us to use samples which are relevant for the current situation and the foreseeable future. So they should not necessarily come from the most conservative time periods in the past. And if the bank has chosen to adjust a sample when it computes LGD or calibrates the LGD model, This, of course, has to be reviewed thoroughly, and the appropriateness of such approaches have to be commented on if necessary. Moving on to the next slide. We would also review the segmentation of LGD models and the risk drivers that are included in LGD models. So as a qualitative procedure, we would explore the entire possible universe of possible segmentation drivers or risk drivers in the LGD models, consider whether or not they were actually included by the bank in the models, and the rationale for this. As a quantitative procedure, we would compute the discriminatory power of the model, using such measures as the power step measure or the loss capture curve, which is common for LGD models, and as well checking tests like the IV test, for example, between different subsegments to see if they're actually different or they're similar and could be combined in a single model. For forward-looking information, we would also identify all possible ways in which forward-looking information could be included into the various components of the LGD model. So we would start by segmenting the LGD model into its core components, like the cure rate and the recovery rates, and we would consider how forward-looking information could be embedded. So how macroeconomic or other forward-looking information could be included there, and question whether or not all of the components are properly estimated by the bank, or whether all of these sources of forward-looking information are actually included. As a quantitative test, we could perform loss shortfall analysis once again, and here we would compare the observed losses for past default events with LGD model outputs after the incorporation of forward-looking information. The idea here is that after you incorporate this information, the actual and predicted losses should conversion should become even closer. And finally, for LGD, discounting is another topic that is important. For instance, IFRS 9 requires that initial calculation, the effective interest rate of the loan, should be used for discounting. But typically in LGD models, that is not the case. Most banks use other measures, other rates for discounting. So we would have to check whether or not a proper link is created between the interest rate that is used for discounting and the actual effective interest rate of the loan. So there should be an adjustment there, which can be checked in a qualitative manner and also checked in a quantitative way. Next, we'll move on to staging. On slide 16, we have a typical staging approach that is used in many banks. Here in stage 3 are loans which are credit impaired, which correspond to impairment triggers of IFRS 9. This is quite close to the default definition used in many banks. This is a delinquency of more than 90 days. These are restructurings or other unlikeliness to pay criteria. And for stage 2, the significant increase in credit risk is made based on quantitative measures such as PDs. So a PD at the reporting date would be compared to expectations of PD at the origination date of the loan. Additional warning signals could be considered for stage 2, and finally 30 days past due delinquency would act as a final backstop. All of these different aspects have to be validated separately when we validate staging. On the next slide, we explore how the general staging methodology is validated. So first thing we would look at is we would make sure that the staging methodology only considers default risk and not other characteristics of the borrower. Even if there are no PDs to properly perform staging for all portfolios, still the factors, the qualitative factors that are used, they have to look at the default risk of the borrower. We would review whether or not the stage 3 criteria are aligned with the IFRS 9 standard. We would review the completeness of the staging criteria by exploring various potential sources of staging criteria. and comparing them with the ones listed in IFRS 9, and ensuring that where the bank has appropriate information, it tried to include it in the staging methodology. If the bank has tried to rebut the 30 days past due presumption, then of course we would have to review the justification for this. We would have to review whether or not the staging methodology is applied in a consistent manner for different portfolios, and that there are some differences, that there is a documented rationale for this. And as well, we would have to look at expert involvement in staging and whether or not there are controls in place to make sure that there are no undue manipulation in the staging results that would significantly affect expected credit losses. And there are other things that have to be looked at, like for instance, whether or not multiple macroeconomic scenarios are considered in staging, if they're relevant, and what are the criteria and processes used for collective assessment of staging. As quantitative procedures, there are a number of things that could be used to assess staging methodology. So the basic tests would be just to reperform staging according to basic IFRS 9 requirements and the methodology of the bank, and ensure that it's implemented correctly. So, for instance, you would have to check that 30 days past due loans are correctly allocated to stage 2, that all defaults are correctly allocated to stage 3, reperformance of the bank's methodology, and a sample of loans could be made to confirm that the implementation is done properly. The 30 days past due presumption, if it is rebutted, the analysis can be reperformed. That was used to justify this, and as well the potential impact on the ECL from a lack of monitoring of the stage 2 thresholds could be assessed. In addition to these, we could perform slightly more complex tests. So for instance, IFRS 9 requires us that the average that loans are moved to stage 2 in a proactive manner. So here, what could be done is we could compute the average time from entering 30 days past due to stage 3, and the average time from entering stage 2 to entering stage 3. And of course, the average time from entering stage 2 should be higher. And as well, default rates of stage 1 accounts, stage 2 accounts, and the accounts which have reached 30 days past due can be compared to ensure that the logic there is consistent with IFRS 9 expectations. Moving on to the next slide, we could as well perform the validation of quantitative and qualitative staging separately. For quantitative staging, typically PDs are used. So here, as basic checks, we would check that it is done properly, that the loan's default risk at the reporting date is compared to that at initial recognition of the loan. That this default risk is the risk of lifetime default, and if the bank uses 1 year PD as an approximation, that proper justification is made, and that these assumptions are verified in a consistent manner. We would check the overall logic of PD thresholds used in staging. So, for example, we would make sure that the thresholds are not absolute, and that they're applied consistently to similar loans. We would check to make sure that the PD thresholds incorporate forward-looking information, and we would make sure that if there are missing origination ratings, that they're treated properly, that proper back scoring has been performed, or if this has not been done, that lifetime ECL is calculated for such loans. As quantitative procedures, we would perform typically the same procedures that we would perform for overall staging, but only considering quantitative SICR. So, for example, we could reperform stage 2 analysis for quantitative tests, for quantitative thresholds, and we can reperform the quantitative tests only for this part of the methodology. For qualitative staging, one thing we would do is we would compare the qualitative factors actually used in the staging methodology with the factors listed in IFRS 9, and would explore whether or not additional factors could have been used by the bank. And here we will also check how experts are involved in qualitative staging. As a quantitative procedure here, we could calculate the proportion of stage 2 transfers that result from qualitative factors, and we could check the discriminatory power of the qualitative factors used in staging. Moving on to the next slide, there are some other components of staging that have to be verified. So IFRS 9, for instance, allows us these simplifications for loans which are low credit risk. There's the so-called low credit risk exemption which could be used. And here we would have to check whether or not there is a proper justification for its use and how it affects the expected credit loss outcomes. Next, we would look at the data and the sample quality. Similar to what we would do for PD and LGD, we could make sure that the staging methodology is based on a sample that is representative of the portfolio and that is calculated over a suitable time period that is relevant for the current situation and for the expected future situations. And as quantitative procedures here, we would pre-calculate staging based on different data samples and compare them to the ones obtained by the bank in its methodology. Finally, everything has to be documented properly, so we would look at the documentation of all the triggers, the documentation of expert judgment, and all of the other associated components of staging. Moving on to the next slide, we'll now go over ECL validation. So here on slide 20, we have a typical structure of the ECL calculation algorithm. Here we can see that for lifetime expected credit losses, we have to forecast the marginal PDs for the loans until their final maturity. We have to forecast the LGDs for different years until the final maturity, and we have to forecast EADs until the final maturity. And we would simply multiply them by each other for different time periods and discount this with the original effective interest rates of the loan. And of course, when we sum up all these different possibilities of losses for all future time periods, the result will be our expected credit loss. So on the next slide, we look at the ways to validate this. So first, of course, we would look at the logic behind this for various products. So we would make sure that discounting is performed properly using the effective interest rates, and that the final outcome is consistent with IFRS 9 expectations, which is the difference between expected and contractual cash flows of the instruments. As a quantitative procedure, we could re-perform the ECL calculations and test the sample to make sure that they're consistent with the methodology. When manual adjustments are made to ECL by the bank's experts, we would check the materiality of this and make sure that this is not done to manipulate the final results. And finally, several backtesting procedures could be put in place. For example, forecasted provisions for previous periods could be compared to current provisions and write-offs to ensure that that ECL is realistic and it corresponds to the actual observed data in the bank. Next, we would look at the segmentation of the ECL for different products, for different types of exposures, to make sure that the calculation is done in a proper and granular way. We would review the documentation of the ECL methodology. And finally, we would make sure that the methodology is applied in a consistent manner for various products and portfolios. And now I'd like to hand over to Petr to discuss the IFRS 9 audit and review tool.
Thank you, Iosif. Let's move to slide 22. So, as you have seen previously, IFRS 9 incorporates a whole set of new procedures which have to be conducted in order to confirm that provisions are calculated correctly. And as long as provisions is the most critical area in banking audit, upcoming IFRS 9 requirements will lead to increase of time and effort spent on IFRS audit. Specifically, Additional experts with knowledge in modeling will be required. More time and more resources will be required to conduct audit of revisions, and thus cost of audit projects will increase. So wouldn't it be useful if there was a tool with predefined set of procedures to be done depending on scope of the audit, materiality, complexity of models, and bank's risk profile? If there was such a tool, it could mitigate above-mentioned problems. So here in PwC Regulatory Management team, we had a large number of projects regarding IFRS 9 development, validation, and review, and thus we obtained a significant collective experience in IFRS 9 issues. And we tried to incorporate our experience in IFRS 9 audit and review tool. So the idea behind this tool is that it could optimize efforts spent on IFRS 9 audit and review projects, standardize such projects, and minimize probability of errors or material misstatements. Now let's look to slide number 23. First of all, IFRS 9 audit tool was designed to reproduce the classical audit process, which could be defined as follows. First, we start with audit planning, then based on that we select specific audit procedures such as test of details, review, or performance. Then we gather evidence, then review should be done by senior colleagues, and then with a feedback loop maybe some additional gathering activities should be conducted, and then audit should be finalized. So we used this process as a template, but we tried to automatize some of these procedures in order to minimize probability of error or material misstatement. So let's look to our process overview. First, project starts with scope identification and risk assessment. And based on portfolios under analysis and based on riskiness of bank and based on complexity of models and materiality, we define procedures which have to be conducted. This is done automatically by VBA macro used in the tool. Then, when audit procedures are generated, auditor has to conduct some tests, including review of methodology, test of details, or performance. In order to simplify these procedures, methodological guidance is also included in the tool. After evidence is gathered, a manager has to review this work and provide a feedback loop so that if not everything is done correctly, then additional evidence has to be gathered. And finally, all procedures have to be documented. So what is the advantages of our tool? First of all, flexibility and efficiency. VBA script generates list of audit procedures automatically based on type of audit, whether it's an year-end audit or quarterly audit or high-level review, based on size of portfolio, based on materiality and complexity of models underlying portfolio and quality of IT infrastructure. And thus, flexible set of procedures helps to save time and resources, preserving high quality of audit. Secondly, our tool is a strict audit decision tree because clear procedural path is followed, and probability of missing any test becomes very low in this case, and thus risks of low quality audit procedures are minimized. Thirdly, our tool is self-explanatory, which means that a lot of knowledge from our previous projects is already incorporated in this tool, and thus colleagues without significant extensive experience specifically in modeling areas could conduct many procedures related to IFRS 9. Fourth, tool has a clear review structure. Thus, manager who has to review work done by auditor will spend less time, and clear procedural and decision tree would enable efficient and high quality review. And finally, tool is done in a way that while doing testing, documentation is done at the same time. Thus, no additional time is required to spend on additional documentation. Documentation can be exported from the tool and uploaded directly to auditing documentation program. Now let's look how this tool actually works. Let's look to slide number 24. So everything starts in area 1, where manager has to input initial parameters such as portfolio type, portfolio amount, model level of model complexity, quality of IT infrastructure, and overall bank's risk profile. Based on these input parameters, in area 2, several worksheets are generated with specific procedures defined by initial model and portfolio parameters. Then, in area 3, you could see an example of procedures. In this specific example, we can see just one question, specifically how forward-looking information is incorporated in LGD model. And here you can see a decision tree depending on how this forward-looking information is incorporated, either by macro overlay or if it is incorporated directly into the model using macroeconomic parameters. Different options are applied. In case if there is a significant matter, then this particular question has to be investigated in more details. If there is a non-significant matter, then influence on materiality should be estimated, and total sum of these influences for all non-material misstatements is summed up and checked whether it is more or less than materiality for this portfolio. Area 4, you can see summary of results for each component of ECL, specifically PD, LGD, AED, forward-looking information, and other areas. Here you can see for each area how many tests are compliant, for how many tests we have non-significant matter, and for how many tests we have significant matter. And finally, if you look to area 5, you can see that results which have been conducted during the audit could be easily exported as an EJ to auditing documentation program. So basically that's the general idea of our IFRS 9 audit or review tool. For more details, please contact Kaan, Aksel, or anyone else from our team. Thank you, colleagues.